In today's world of fast-moving investments and money and the ability to move cash offshore, onshore, do yourself trading, historical sort of stockbroking, we look at investments and we have certain expectations. So in today's short video, we'd like to have a look at the nature of markets in general and what we should actually expect out of these. Today, I've got Craig with me, and he's here to share some of his sort of knowledge and experience around what realistic expectations we should have out of market returns.
One of the key issues we find is that people don't have realistic expectations of their investments. So it's quite important that those realistic expectations are grounded. So for example, if you think about investing, it's really storing your wealth so that you can use it at a point later on in your life. If you look at the places you can store your wealth, it's actually very simple. You've got equities, you've got property, you've got bonds, and you've got cash. And essentially that same suite of asset classes is available locally and in every region in the world. And they're actually, the returns that you get are very similar globally if one measures those returns in that currency. So quite predictable in the long term, but very unpredictable in the short term. So what do we expect from those asset classes? Typically equities beat inflation in whichever economy you invested in by about 6 to 8%. Property around about 4 to 5% better than inflation. Bonds about 1 to 2% better than inflation after taking taxation into account. And then cash generally only about 0.5% to max 1% ahead of inflation if you take into account income tax on that. So that's the underlying framework in which every person is invested.
So that's an interesting point you raised there, Craig, because I think some of those figures tend to come out of since about the 1900s. They've been recording that not just in South Africa but globally. You know, that's over 120 years of history now. But even if we look at the example of the last, say, 20 years, we can see this pattern and this trend come through. We've got a graphic up there now just sort of illustrating these asset class returns that Craig referred to against the likes of what inflation has been locally in South Africa. And what you'll notice there is there's a few highlighted blocks which show you where the negative instances occur. Now, we have expectations, but the reality is we know it's not a straight line. We look at averages. But I think also probably the key that we like to point out here is if you look at the likes of inflation and then something like cash, cash doesn't have a highlighted return there, but how it at best keeps pace with inflation over that long period of time. And, speaking about time and looking at the relatively volatile nature of some of these asset classes, we've heard be invested for the long term. Where do we go with that?
Yeah, so it's an interesting one because if one looks at sort of the very best and worst case scenarios over a short period of time, there's a massive amount of volatility. So if one looks, for example, at the Johannesburg Stock Exchange over the last 120 years, yes, you have had these extreme examples where markets are down 29% in the worst possible case scenario over a calendar year, but up 107% in the calendar year. That's unlikely to reoccur simply because that was many years ago when the market was a lot smaller and very mineral dependent. But it just goes to show over the 1 year period how much volatility there could be. But as soon as one adds the benefit of time, as per our graphic, you'll see that over a 5 and a 10 and a 20-year time horizon, those returns become significantly more predictable. And it's that predictability in the long term that we like to build into the financial planning process and make sure that investors understand that they need to be invested for the long term because the short term is just so unpredictable.
No, for sure, Craig. I think if we put up the illustration that we've got there, it's showing over a 60-year period what has happened on the Johannesburg Stock Exchange. So if you'd simply been an investor through these 60 years, and we use 60 years because typically that tends to be somebody's investment lifespan. If you think about it, you might start working around the age of 25, stop working sort of in your early to mid 60s, and then maybe sort of have some retirement years pass away sort of somewhere in your 80s. And if you look, we can only look back to give illustration, but if we look back over that 60-year period and all the events that occurred. You know, if you think locally within South Africa, sort of apartheid and sanctions and all of the other kind of atrocities that were happening during that time, into sort of a transition into democracy, some of the more global effects, you know, we start to see the influence of the great financial crisis in 2008. But sometimes if you look at that, the shape of that graph, and you realize that if you've been invested for a long period of time, in the moment, it can feel like a drastic movement when we look at that 1 year figure in terms of that range. But if we take a step back and we hold perspective on it, you know, how much of an effect does it have over your portfolio in totality? And that's why, you know, you'll hear financial professionals, financial advisors boring you to tears when we talk about invest for the long term, invest for the long term. You know, it's not because we're boring and lazy, it's because it's proven, but it's probably the hardest thing to do. But now we've kind of looked at those two examples on say a pure equity basis. Now, the typical investor is not going to go full equities, full risk. Most of us will hold the majority of our investment assets in the likes of our retirement funds, which we know do have certain legislative restrictions, but also realistically, we wouldn't expect to hold such an aggressive investment. Craig, if you could maybe look at how we look at different examples in terms of something like a balanced fund as it's become to known in South Africa.
The first thing to understand is what is a reasonable expectation when you are limited to 75% equity exposure. And we know that equities get you inflation plus 6 to 8. And obviously, when you look at the different proportional asset allocation models, they will tend to come out with an expectation after all costs of no better than around inflation plus 5. So if we use that as a starting point, and we know that 75% of your money is in equities in order to get you the inflation plus 5, and we know that equities do have these bad years from time to time, the question then is, well, if I invest my money today, 1 year out from now, what chance have I got of losing some of my value if I'm just using 1 year time horizon as the benchmark? So if we find that our clients are more comfortable if that number is quantified, and that number, if you look at the chart that we're showing you now, is around about 18% probability of a negative return in year one. Of course, we invested for the long term. We're not going to draw that money out after a year. The intention is that it remains invested over many, many years and provides you with an income where just a small proportion of it is drawn on a monthly basis. So if one looks at the probability of a negative return over a 5-year period, it becomes a lot more negligible. And over a 10-year period, it's literally not. We haven't had a period in history where we would have recorded a negative return over a period that long. So once we've covered that issue of, well, how often is it going to be negative? The question is, well, how bad could it be if it is negative? And Gareth, you maybe wanted to share on that.
Yeah, I think it's an important point because we looked at what is the likelihood of an explicitly negative return. But another way of looking at it, as you'll see there now, is looking at that shape and that range. And I think the first thing you said was that, you know, over a 5-year period there's about an 18% chance, almost like sort of a 1 in 5. So if you look at the sort of 5-year column there, you'll see how that shape kind of moves towards the fact where the likelihood of a negative return sort of almost falls away. And by the time we get to sort of 10, 20-year scenarios, we're at the point where we just simply have not seen a negative return on these so-called balanced funds, you know, where we're blending asset classes together, bearing in mind that it's not just held locally, it's held abroad as well. So a lot of flexibility in there. We can sort of factor out some of the currency movement risk, certain investment markets that maybe not be available locally versus abroad. So the world's become a much sort of more accessible place. We look at history to show us what's happened in the past, but you know, the future, we would expect it to keep repeating as such. And even in those times of negativity, that's often sort of the breeding ground for more positive returns. It kind of leads to innovation in that. So we know the benefits of time, and we can see that, you know, through consistency and persistency through hard times should give you sort of the result that we're looking for and expecting over those longer periods.